Robert started off with avoiding macro, as he said, as he noted when he began. And I am actually going to dig into a bit of macro here. I was talking to some friends last night in the bar, actually the organizers of this conference, and they were desperate for some good news, and I promised them that I would give them a positive presentation this morning. So I had to rework the presentation to make it positive, but we'll see. I do believe, generally speaking, that we are in for better days in the junior mining in metals market. I think we are at what I hope to show you is a long-term bottom, the kind of a bottom that in the past has presaged a dramatic uptrend. The good news for us right now is that the macro picture favors an uptrend. It actually is one of the more dynamic, compelling macro setups that we've ever seen in this market, and I hope to show you why. But the key thing to know here is that the pivot has been postponed. As over the last year or so, I looked over some of my previous presentations, and about a year ago, we were talking about, at this conference, the pause and how the markets are trying to price in the pause. That, too, was delayed about 4 or 5 or 6 months from when the markets just started to price it in. We've undergone a similar thing with the pivot, and I'm going to show you how, I hope. Here you see the gold price over the last 6 months. You can see that big drop last October. But then you see a run-up in late October into November, and then December we had an all-time high in gold, about 2080, 2085 on a spot basis. And at that time we were expecting a really good 2024 because there's typically an early year uptrend in the metals and the mining sector. There's typically a rally, whether it lasts 30 days or whether it lasts into June. Or longer, it varies, but there's almost always an early rally. However, the new year rang in and the market started to drop. And those first few days were kind of, for me, nerve-wracking because I knew we had to get started and we just weren't getting started in January. And we haven't. We had a couple of dips toward 2,000, dropped below 2,000 for all of 2 days on a spot basis. But on the futures basis, continuous contract, active contract, we maintained above 2,000, which is important. As you can see, we kind of fluctuated above that, but 2,000 has become a very strong floor. In my newsletter this month that just came out the day before yesterday, the title of my lead article was Inertia, the tendency of a body at rest to stay at rest. Or in motion to stay in motion in the same direction. Right now, where we have inertia in the gold market, there's nothing pushing it higher or lower, and a complete absence of buying from some sectors. I want to go over briefly gold and treasury yields because I think it has some implications going forward. Gold and the 10-year treasury yield should be contracyclical. They should be inversely correlated. Higher yields should lead to a lower gold price. And if you look at that rolling 20-day correlation, the chart at the bottom, if it's below zero, you have that negative correlation. For a brief period in November, late October and November, we had positive correlation. And that's important because of the reasons behind that. At that point in time, we heard talk about the tremendous expansion in the federal deficit in the U.S. and the growth in the debt. And there were doubts about the U.S.'s ability to pay that off, or at least the value of treasuries at current low yields. And the market began to demand higher yields. This uptick in treasury yields was not due to anything by the Fed. It was the market saying, for that kind of risk, we demand a higher return on our treasuries. Those are the infamous bond vigilantes at work, and I think they're going to return. Gold and the dollar, we see the same thing. In that period, we actually see a positive correlation between gold and the dollar. You didn't need a lower dollar to get higher gold prices. The dollar, because as you can see, this reaction was not quite as pronounced as in Treasury yields. This really revealed that the dollar was driven by Treasury yields. So the dollar doesn't drive gold, and that correlation, that's what I believe is something that the market gets wrong. A lot of people say lower dollar, higher gold, vice versa. The dollar does not drive gold. They are both driven by Treasury yields. That's the big important factor in the markets. And a higher Treasury yield actually led to not only a higher dollar, but a higher gold price during that brief period. Again, I think that's going to return at some point. The big picture that I'd like to stress, and I have been stressing for a couple of years, is that we're entering the end game of a 4-decade-plus process of not easy money, but ever easier money, a process in which the markets have become addicted to ever easier money. This is the chart that tells it all. This is a chart of the gross, the federal funds effective rate. That's the blue line. And as you can see, back here in the 1980s, when Paul Volcker killed off inflation, he started trying to normalize rates. In that period of time, that meant lowering rates. So he started lowering rates, but then we had these recessions. And whenever there was a recession, they would either, in this period, accelerate the decrease in the Fed funds rate, or instead of trying to normalize it and raise the rates, they would drop it. So what you had, that every time there was a little bit of hiccup in the economy, they had the same prescription. They would lower the Fed funds rate. And then when they would try to normalize it, they couldn't do it. They couldn't get it up to even the midpoint of the previous range before it would precipitate a recession and they'd have to lower again. So we have this 4-decade process of ever easier money. And then in 2008, we knew what happened. They had to bring it straight to zero. And then they came out with quantitative easing and a lot of other acronyms and programs to just inject liquidity into the economy. At that point, Wall Street, the financial system. Then came COVID, and they did everything that they did during the great financial crisis, but instead of doing it over 4 to 5 years, they did it over 4 to 5 days, and they did it to a multiple of what they did before. A couple of lessons here. The next time there's a crisis, they're not only going to go to zero immediately, but they're going to do a lot of other programs to inject monetary adrenaline directly into the veins of the market. And it's really going to make your head spin, because whatever they did the last time, they have to do that much more to get the same effect, because the addict has developed a tolerance for the drug. The other big point is, what do ever lower interest rates do? They promote debt creation. And this red line is the federal debt. And it has grown, and this is by the Fed's numbers, which understates the number. It's actually $34 trillion right now. So these debts have grown while the interest rates have been going down. That creates a problem, and this is the problem. The Fed is running into a brick wall. This is federal debt and interest expense. Federal debt is the red line, and you can see it has grown precipitously. But this federal debt expense did not grow nearly as quickly because interest rates were still near zero post-2008. But when we started raising them, the leverage effect has sent this line on a parabolic course. It is near vertical right now. National debt, $34.27 trillion. This is an old number. I had to do this chart about a week ago, or did this chart about a week ago. And I could have updated it, but I didn't, because I wanted to update it right before I came on stage and tell you what the difference is. In that 1 week, this was the number a week ago, that debt has risen by $136 billion in a week. If you annualize that, it comes out to almost exactly $7 trillion that would be added to the debt over a year at this rate. I don't think that's going to happen, because we're in a period where it's growing a bit more quickly before we get the tax receipts in. But that's the run rate right now. It's a $7 trillion increase in the federal debt. I think we're probably going to end up with about $3 trillion this year increase in the federal debt. Here's the brick wall. Here's what happens when you have debt this large with rising interest rates. That leverage creates this situation where you were going nearly vertical on interest rate expense. I have been predicting for a number of years that we were going to cross the $1 trillion a year threshold, and we just did. That, I think, is a magic number that has political considerations as well as economic. We're now paying more in the U.S. on interest on the federal debt than we are paying for national defense or any other single budget item. And at this rate, it's going to encompass the vast majority of all of the entitlement spending and national defense. It can't happen. So where are we now? Investors are reaching forward in the dark for a Fed pivot. When is the Fed pivot going to happen? We thought there, for a while the odds favored March. Now the odds have shifted firmly against even a May move. I think we're likely, if you look at the odds, if you look at the Fed funds futures, I think we're looking probably at June. So again, like we had for the pause, the market's trying to price in, was trying to price in a pause. The pause came 4 or 5 months after they started to price it in. For the pivot, a similar situation is coming. We had that big run up in December when the market started pricing in a March cut. So what we're having now is a reawakening, a resetting of those expectations, and we're likely to get that cut sometime in June, maybe May, but June or July, I think, most likely. The challenge for gold right now, I mean, the good news is that we're above 2,000. We seem to be rock solid above 2,000 for a couple of reasons I'll get into in a moment. But the markets don't care where you are, where a price is. They care where it's going. And until we have a breakout above what I think is 2,100 or 2,150, I don't think we're going to be able to convince the market at large, the generalist investors, to come into this sector until we prove that this move isn't just another one of these failed advances, these peaks where we weren't able to get quite beyond it. You know, we talked about a triple top for so long. That's 1, 2, 3. Now we're talking about a quadruple or even quintuple top. Unless we get to 2,100, 2,150, show the market we have a clear breakout, they're going to look at this chart and saying gold is capped. It can't go any further. That's the challenge right now. The bad news, good news, is that Western buying has been completely absent in this move. If you look at the all-time peak in December, we had that nice run-up. This, by the way, chart is the holdings in GLD, the Spider Gold ETF. Those holdings are in red, and the blue line is basically the price of gold, the price of GLD. So you see when we got that peak in December, the holdings in GLD didn't rise. They were pretty much stagnant. That rise did not attract any new buying. And in fact, as gold failed to go higher, failed to make that new breakout, we saw interest fall off. It's actually falling off a figurative cliff here. Western investors, and this is one of the best proxies we have for Western gold demand, Western investors have been totally absent from the market. Another view of that is through the open interest on the COMEX in gold. Here's a chart of the open interest. You have in blue the commercials, you have in red the non-commercials, basically both sides of the market being long or short. And you see as those lines, those bars collapse, in areas where I've marked with this green line, when we have a significant decrease, it's usually presaged a significant rally in gold. The only time in this 3-year chart it didn't was in the summer of 22, when that was kind of a false signal, but you had to wait 4 months or 5 months, and then we got the real signal and a significant rally in gold. We're at that kind of a point again where open interest has collapsed, And at some point, again, we're reaching into the future trying to figure out when. Timing is always the trick. But we are within weeks or a few months, I think, of a significant rally in gold based on the lack of interest from Western buyers. Now, this lack of interest isn't necessarily a bad thing, and I'll get into that in a moment. But the other reason why, when gold has been staying above 2,000 is that there has been price-insensitive buying. Strong bids below the market coming in regardless of where the price goes, not the kind of fickle behavior we typically see from Western investors. Big part of this, central banks. You can see that 2022 was by far the record of central bank buying in gold. 2023 was not far behind it. These central banks seem to be on a buying program to build up their gold reserves. They don't really care what the price does. So when the price drops below 2,000, you still have this underlying demand, or when it approaches the 2,000 level, this underlying demand keeps it elevated above that. Now, I had thought that we were not getting any Asian demand in gold. Last month at the Vancouver event, I actually said the Asian investors have not been involved because Asian investors are typically very price sensitive. They buy in price declines. They buoy or support the gold price on a decline, but they're bargain hunters typically. That seems to have changed. And we got data in for the Shanghai Gold Exchange gold withdrawals, which is the best proxy we have for domestic gold demand in China. As you can see, that soared to its second highest level ever in January. And what's happening is that Chinese savers, investors, are buying gold hand over fist now, despite the fact that the price is near an all-time high. Now, this is obviously due to the domestic situation in China to a large degree, but it's still there. The good news is that when Western demand comes in, when we have that breakout, Western buyers are trend followers. So they're going to come in and exacerbate a trend that's going to be already in effect. So we are, for perhaps the first time that we've ever seen, we will have Asian and Chinese buyers buying at the same time as Western buyers. So this next move could be particularly explosive. This is a great chart by somebody who posts on Twitter, X, the Hedgeless Horseman. I just saw this the other day. Gold stocks are a generational value. If you look at the ratio of the NASDAQ 100, the tech-heavy stocks, to gold, this has been the best buying opportunity, the best value since 2000. And remember, in 2000, it took a couple of years for gold to get off those lows of around $252 an ounce before the mining stocks got moving. With gold now near an all-time high, we only need a few weeks of a determined uptrend, of a consistent uptrend for the right reasons, i.e. a Fed pivot. We only need a few weeks for all of those mining stocks out there are going to really take off and respond quickly. The FOMO kicks in very quickly. Importantly, gold, if you see this, the gold line is gold in this chart. The green line is the Fed funds rate. We have undergone perhaps, arguably, the harshest Fed hiking cycle in history. And over that period, from these lows to these highs, gold has gained $400 with, again, arguably the strongest headwind ever for the metal. And it's actually gained $400 an ounce over that period. So when those headwinds shift to tailwinds, when we get on the downside of this cycle and the Fed starts cutting rates, you would expect gold to do considerably better. How good? How good can gold get? Well, this is a chart of the long-term real gold price, inflation adjusted. The 1980 high of $850 in nominal terms is equivalent in today's dollars to $3,354. Even the August 20 high, post-COVID, is equivalent now to $2,442. We are going to get above 2100, 2150, and then we're going to get to the mid-2000s, I think, very quickly. Long term, what's the potential? If you look at the bull market in gold from 1970 to 1974, the price went up 5.6 times. From 1976 to 1980, it went up 8.2 times. From the 2000 to 2011, it went 7.5 times. The low for this cycle is around $1,040. If gold is going to go up 5 to 8 times from that low, that's the kind of potential you see in a multi-year bull market in gold. Bottom line, the Fed is going to pivot. Only the timing and degree remains in question. Gold did well during the hiking cycle. It should do spectacularly during the cutting cycle. We need to clear 2100 to show that clear breakout. And unlike the last time we had a big breakout in a bull market, gold's already near record highs. It won't take much of an uptrend to really kick off the juniors. This is why I call this a generational opportunity. It has been 24 years now since we've had this kind of opportunity. We're due, and I think it's going to be explosive this time around. That's all I've got. I hope it's been positive. I hope it gives you a more positive attitude to take advantage of the bargains we see out there right now. You can follow me at goldnewsletter.com, subscribe at goldnewsletter.com. The New Orleans Investment Conference is in late November this year. This is our 50th anniversary. All the cool kids are coming. I hope you make it as well. It's going to be a lot of fun.